Good morning, everybody. Happy Friday, February 26th. Today is the final day of our 2021 SUBStrong event. And as most of you may be aware, today is Gift Card Friday. At the end of every session, we will be drawing from the attendees at each session a winner of a $50 gift card. So we'd like to thank all of you for joining us. My name is Cindy Novak. I am the regional manager for the Blue Book here in Colorado. The Blue Book Building and Construction Network has been around for about 108 years. We help make relationships within the construction industry and helping you share your unique story within our network, online, in print, and in person. Today, I'm very pleased to be sponsoring today's keynote presentation, Valuation, Valuation, Valuation. So what is your company worth? Not just a balance sheet discussion. How are decisions made? What is your budgeting process, your employee retention, your culture, and your communication? What is the relationship between operations and qualitative and intangible assets? The goal of today's presentation is to know the value of your company, to grow, manage, and most importantly, maintain your value. Presenting today's keynote is Adams Price. Adams is the managing director with P&M Corporate Finance. Adam has over 20 years of experience in strategic planning and execution for mergers and acquisitions, transaction development and execution, P&L management, consulting services delivery in strategic services, ERP selection and implementation, e-commerce strategy, selection and implementation, as well as management consulting. In addition, Adams has over 20 years of direct experience in merger and acquisition transactions, as well as capital formation transactions. So it's my pleasure to introduce Adams. Adams, take it away.
All right, thank you very much. Very kind introduction. All right, I'm going to share a screen here. Okay, so we have a chat box over on the right here. So if there are any questions that anybody has, feel free to put those into the chat so that I can address them. I'd like to keep this as interactive as possible as we're going through this, make sure it's valuable for you guys. So let's launch right into the discussion. A brief commercial, I guess. As mentioned, I've got a bit of experience in investment banking, about 20 years of investment banking across a number of different verticals, but also in construction. I'm working with a client right now, as a matter of fact, in specialty construction, and have worked with electrical contractors and various aspects of construction industry throughout my career. So I have some exposure specifically to the construction industry, which is quite different than other industries such as software or the manufacturing, distribution, et cetera. And so we're going to talk a little bit about some of those things about the construction industry specifically that impute value to a business and that can leak value out of a business, just so you can think about as you're growing your organization and you are trying to figure out what the next step on the horizon is. You can keep at least an eye on some of these things that have a significant impact on the value of your business. So, of course, I've got to go through a little bit of overview of PMCF itself, and I'll keep that brief so we can hop into what's really going into what's really going on in the M&A world right now, and well, what was going on in 2020, but more importantly, what's going on in 2021, and then also valuation considerations, get into the real meat of things that you can do that will help increase the value of your business. Briefly, PMCF is an affiliate of Plant Moran. It's been around for about 25 years. It has offices in Chicago, Detroit, and Denver. We're about 25 investment bankers across a number of different verticals, everything from manufacturing, distribution, to plastics and packaging, to tech, to healthcare, and of course, construction. So we cover a number of different areas. We're kind of unique in that we we assign at least 2 managing directors, senior people to every single project that we work on. We're fairly low volume, but high touch in the way that we go about working with our clients. We find that we get much better outcomes that way. So we also have quite a bit of international reach. We are the founding owner of a group called Corporate Finance International, which is about 200 investment bankers across the planet. So we do have access to both sources of an interest in acquiring companies from an international standpoint, as well as sources of capital from an international standpoint. Just gives us broader reach, gives us the ability to better serve our clients. And as I mentioned before, we're an affiliate of Plant Moran, which is very beneficial for us and for our clients from the standpoint that we can provide a much more holistic solution to our clients, such that we can bring tax and we can bring assurance and we can bring transaction services and consulting and everything to bear for our clients so that they get a total solution, which is really important these days because getting a deal done, it gets increasingly difficult. And multiples are very high, and due diligence is onerous, to say the least. And so you want to make sure you're only going through it once. And so you want to make sure that you know what you're getting yourself into, and you want to make sure you know what's coming around the corners before you get to those corners. And a whole more holistic solution can help you figure that out. And then there are a bunch of tombstones of things that we've done over the years. And so I'm not going to go into a lot of detail on those. But you can certainly go out to our website and see more specifics on the services we provide if you're so inclined. But let's hop into really the meat and talk just about what's going on in the M&A world in general. And then we can talk specifically about things that impact you and the things that you have control over that impact you. So to start with, this is what M&A has been looking like over the last several years. It's been a pretty frothy market in general. And you can see the deal value and deal count have been pretty, there was a surge certainly in the deal value in Q4 of 2018. But other than that, it's been a fairly flat and high level of enterprise value that's been traded in the private capital markets over the last several years. It's been a strong marketplace without, of course, COVID hits and things drop quite a bit substantially in Q2, and we believed at that time that that's probably something that would continue for quite some time. We looked at a 2-year horizon and thought, okay, it's going to be significantly depressed as far as M&A activity is concerned, and it's probably going to be pretty depressed as far as multiples are concerned. That didn't bear out. Our crystal ball was wrong, and it bounced back quite a bit, particularly in the fourth quarter of last year. And it's coming out of the chute pretty hard for a number of reasons this year. And so, and I'll get into a little bit of that, but mostly what you're seeing here is that the way the capital markets are working right now, there is a lot of money on the sidelines. There's a lot of money in private equity. There's a lot of money in balance sheets. Actually, a lot of companies across the planet were able to accumulate a lot of money, a lot of capital on their balance sheets as they were spending less, but they were still getting quite a bit of revenues. And you see that across a lot of areas, and you see that certainly in the construction space. And that coupled with the fact that there's a lot of money parked with private equity that needs to be deployed, read that around $1.5 trillion, at least domestically, and you end up with basically what's a supply problem. There's a lot of demand for good companies out there in the marketplace, and there are less companies available that can fulfill that demand, and therefore the multiples get quite high. And we've seen that across a number of different industries. There's just a lot of demand out there, and we foresee that demand will continue for quite some time. It slowed down. They were backing off, maybe going after companies in Q2, but they jumped right back out in Q4, and that's definitely what we're seeing coming into 21. Looking a little bit more granularly at the construction industry itself and transactions that have taken place. And by the way, I want to be careful in helping you understand the data sets that we're providing and that I'm showing here. Some of them are from PitchBook, some of them are from CapIQ, which is another data set. Some of them are from GF data, which is yet another data set. They're all directionally very similar, but they're different data sets. So you'll see some discrepancies between each of the data sets as I provide some of these charts. Don't worry so much about the discrepancies there. Think more in terms of just directionally, where is the market then, and where is the market going? You can see with construction, we saw similar kinds of things happen with a kind of a downturn in some of the transactions that were taking place. Certainly in Q2, the number of transactions dropped pretty substantially. Not a surprise with everything that was going on with COVID, but you also see that it was a V recovery, which we're seeing across several different industries where what we thought was going to be maybe what we referred to at the time as maybe the downswing with more of a Nike swoosh looking recovery. Thought about the W recovery, you've heard the K recovery, all sorts of different recoveries. Mostly what we saw was a V recovery. Things just jumped right back just snapped back to the mean really of what transactions have been transpiring. And so you can see that it's still a frothy market. There's still a lot going on in the marketplace, particularly in the construction space, which probably you should be thinking about and considering out there, because there are some opportunities for good companies and well-run companies. And I'll define that in just a little bit as to what that really means from our perspective and from the buyer's perspective when looking at a company in the construction space. Going to spend a little bit of time talking about where the valuations are for companies. In general, this is just from a market standpoint across a broad spectrum of companies as you can see, specialty trade contractors and building equipment contractors. Just to give you a sense, a flavor of what kind of valuations in general look like in the marketplace. On the top there, specialty trade contractors in 2020, overall for all companies in that sector, the average EBITDA multiple was around 6.5x, and that's across all of them. But devil's always in the details, right? So you can see that for companies that are in the 10 million to 25 million enterprise value range, the EBITDA multiple is closer to 5.2x. So more than a turn of EBITDA lower for companies that are that small, that size compared to the total sample set. And then you can see, of course, it goes up as the size of the company gets bigger. There's a lesson in there, and this is true across any industry, really. The larger a company is, and the larger economic or total economic value, or the largest purchase price value of a business, generally results in a higher EBITDA multiple. And the reason is simple: there's less risk associated with buying a company that's a $250 million company than there is in buying a company that's a $25 million company. And the reason why is because, frankly, the buyer has to work harder to screw up a $250 million company compared to a $25 million company. For a $25 million company at 5.2 times EBITDA, that means that $25 million company has about $5 million of EBITDA. And you mess up one customer, you mess up another customer, and all of a sudden that 5 million EBITDA drives down to zero pretty quickly. And that can be really scary for a buyer to take on that kind of risk. More risk associated with it, lower EBITDA multiple. On the other end, when you're talking about a company that's 250 million in enterprise value, it's got an 8.5 times EBITDA multiple on average, because there's less risk, and so the buyer can pay more. So that's something to think about when you look at the marketplace and look at the size of your business and the revenues that you're driving and the EBITDA that you're driving. There is a direct correlation between the size of your EBITDA and the size of your multiple. Building equipment contractors, a little bit higher, 6.9 times EBITDA in 2020. Similar kind of trend as far as smaller companies versus larger companies and the imputed EBITDA multiple just because of the risk profile. So again, a lesson there. There are a couple of other ones to look at with kind of look at foundation and building exterior contractors. They're a little bit higher in EBITDA that they're imputing. 5.5x in that case from 2018 to 2020. There hasn't been a lot of variability between those timeframes, but you can see that there's also less number of deals as we drill down into more specialized types of construction. There are less number of deals, a little bit less significant as far as reading into what those multiples are, just because there are less number of them statistically. Plumbing, heating, and air conditioning, actually the HVAC side, that has been pretty white hot for a while, particularly for those where they have maintenance contracts over time with buildings and with commercial buildings mostly, where they are generating recurring revenue over time with those maintenance contracts. That's when they start getting into some really high multiples for those businesses. There are a lot of private equity groups that I get contacted by very consistently, looking for HVAC companies because they fit a profile that is typically very consistent and predictable revenue and earnings for those businesses, which makes them less risky and which makes them more valuable. And so we do see a lot of demand for companies for that. Larger ones that are more like platform companies, and then smaller ones that are either tuck-ins or can be platforms for smaller PE groups. That's just a very attractive marketplace right now in general. And then you can see electrical and wiring installation contractors, 6 times EBITDA, which is actually a pretty nice number right now. I did one a while ago where we were actually right there about 4.5 times EBITDA back in, I think it was 14, not 15, but we ended up with that was a pretty good number at that time for us to be able to get that deal done, and that was in the 10 to 25 million enterprise value range. So we're right in there with where the market was at that time. Those businesses would do a lot better now. They're more than a turn more of EBITDA multiple for those companies right now. Again, because there's just a lot of demand out there for good companies like that are well run. Building finishing contractors, you can see what that is, 6x. And then when you're talking about other specialty trade contractors, then we're talking about 6.4 times. I'm working with a company right now that is more on the specialty trade contractors, and I think that's right in line with where we're going to get. We're just now going out to market with them, so we're just hearing the interest, but the interest has been pretty strong. I'm assuming that we'll probably have 5 to 6 bidders on that organization because it's well run and it has a lot of the characteristics that I'll talk about for really good, valuable, sought after companies. And we'll talk about what those characteristics look like in just a little bit when we talk about valuation considerations. But so you can see that you're talking about values that are ranging between somewhere around the mid 4s to the mid 6s for a lot of these construction companies. So some pretty good multiples out there in the marketplace. Talk a little bit about valuation considerations, and then talk about I think probably what you're going to get out of this mostly is that there are some things that you have a great deal of control over that can change the perceived value of a business. And then there are a lot of things that are more macroeconomic oriented that you can't do anything about, and that you are at the effect of those kinds of those factors in the marketplace that would change the perceived value of your business specifically. And so I'm going to go into both so you get a sense of how both of them impact you, but then also get a sense of which ones you really need to focus on. When you talk about valuation methods, we use, and actually buyers, more importantly, use these 3 methods for valuing a company. Of course, discounted cash flow is just looking at what your future projected cash flows are going to be and what they're and just basically taking those and putting against a factor of net present value, so it brings it back to today's dollars, and boom, there you got your value of the business. And there are other methods, of course, comps analysis, where you're taking comparable transactions and you're taking comparable companies that may be even in the public market, and you're discounting the stock price because of liquidity premiums, that kind of thing, that brings it back to an amount that constitutes a value range that makes sense, but they're kind of comparable companies. And then you have precedent transactions. You have actual transactions that have taken place recently that look similar to the company that we're valuing, and those transactions show where buyer and seller met right and agreed a price, and that is technically the definition of what an enterprise value for a business is when willing buyer and willing seller agree a price. And so we do look at precedent transactions. Challenge of precedent transactions, of course, is that no two companies are ever exactly the same. And so there can be any number of characteristics of a company that were attractive specifically to a buyer for them to come to agreement on a price. And sometimes it's harder to discern necessarily what those are in any given any specific situation. And therefore, we look at a number of different precedent transactions over a couple of years in order to come up with a number, so that we can kind of divine into what an enterprise value might be for a specific company. The thing to realize about any kind of valuation at the end of the day for a company is that it all depends on what the perception of the future after-tax cash flows will come from a business. People talk about multiples of EBITDA, and they talk about how performance over the last couple of years imputes some kind of value. Well, that's already happened over the last couple of years. You've already taken the cash out of the business for what's transpired over the last couple of years. There's really no value in what has transpired over the last couple of years. It is the value of what a buyer can derive from the business going forward as soon as they actually do that transaction. Kind of as a proxy, they look at what the past performance of the business has been in order to get some sense of how the future performance of that business is going to play out. And so a lot of value that can be created for your business or can be demonstrated for a business is how you project future earnings, how you project future revenues, how you project future capital expenses that are going to be necessary to help refurbish your equipment or to increase the amount of equipment you have in order to execute on your projects. All of those things go into a picture of how much after-tax cash flow is going to come out of a business in the future. And that really is the basis of what the value of a business is. A lot that has to be focused on those kinds of metrics when you're thinking about realizing the value of your business, selling your business, bringing in a partner to provide some financial diversification for you as a business owner. Those kinds of metrics are going to be extremely important to the buyer. Now, there are some things that you have power over in order to be able to impact what the value is going to be. And there's some things that are more of a macroeconomic view for your business that you don't have any real control over, but you have to be aware of them. You have to be aware of how they're going to impact the market in general. And these are just a few of them, of the larger ones that we're keeping very close eye on right now, and that really do have a significant impact on how businesses are valued. Excuse me a moment. But again, there are things you don't have control over. You just have to watch them. You have to be careful. You have to be aware of them. And they basically imply a window of opportunity to sell your business. And so I'm just going to kind of go through these. A big one right now, of course, is that there has been a change in the administration, a change in Congress, such that one party has a significant amount of control over the legislation and the legislation that's actually signed into law for the coming years, at least for the next couple of years. Throughout the elections, of course, the Biden campaign was talking a lot about how they're going to change the tax regime by taking the corporate rates back up from 21 to 28%, and maybe even increasing the capital gains rate from 20 to 40%. And there's all sorts of discussion and debate around how much that's really going to increase. But the consensus is that probably there's going to be some tax change that takes place, and probably pretty significant tax change that takes place in 2022. And so that's going to change the window of opportunity for selling a company in two ways. The number one way is because of the increase in corporate tax rates. That means in the future there'll be lower after-tax cash flows that come to buyers, and therefore they have to build that into the value that they would put on a business. So if you've got your corporate taxes going up from 21% to 28%, then that could shave off about, I don't know, maybe 10, 15, 20% of perceived value of a business, just because the after-tax cash flows are going to be lower. At the same time, for the sellers, this could have a pretty significant impact as well in 2022, in that if the capital gains rate goes from basically 20% at a federal level up to 40% or somewhere close to that, that's going to have a significant impact of your take-home after tax in selling your company. Some groups, when they're looking at the marketplace right now, are saying that if I'm thinking about selling in the next 2 to 3 years, I better sell this year. And we're getting a lot of those calls, frankly, because the tax treatment, at least from a capital gains rate now, is absolutely beneficial to how much a company owner takes home after tax compared to what it probably will be in the future. And so if there's a time to take advantage of that, it's a time to take advantage of that now. And so we're getting a lot of calls on that, just saying, hey, can we get a deal done before the end of the year? And in most situations, the answer is yes. If we start at the first half of the year, then we should be able to get it done before the second half of the year. But the clock is ticking without a doubt. We always keep track of the amount of private equity capital that is out there to invest. It is increasing constantly, which is a good thing, right? That just means there's more capital out there vying to be able to invest in private companies, and therefore there's more competition, and that tends to raise the value of good companies because of the competitive process. It's important to take advantage of that competitive process. The way that the private equity groups in particular are trying to find their opportunities to deploy capital now are to find companies that aren't running a process, aren't running an auction. And the net of that is that the private equity groups, they call it proprietary deal flow, by the way. The private equity groups who can find that proprietary deal flow that's not representative, they usually can get the deal done for a lower valuation, which is beneficial to them. So I'm sure a lot of you are getting those calls, the phone calls with, hey, I want to buy you, I want to buy you, I want to buy you. Those are guys who are calling to find someone who is not represented, who's not running an auction, and see if they can get a deal at the lower end of the valuation, of the value range that you might find for any particular business. When we run our processes and we have private equity involved, for good companies, we're talking about having maybe 15 to 20 bids coming in on a business. And we run a process to maximize that, such that we keep the competitive environment going as long as possible in order to make sure that we're getting highest and best terms. And that competitive process is the best way to do that. It's a good time to take advantage of that. And I think it'll be a good time to take advantage of that, all things being equal, well into the future, because private equity and flush balance sheets, frankly, on strategics, are creating a lot of competition in the marketplace. At the same time, I think over time, everybody talks about the silver tsunami, right? older owners of businesses who are eventually going to either pass their businesses along to the next generation, or they're going to sell their business in some way, or they're going to shut them down. You hear the various Deloitte and Touche studies and KPMG studies and Grant Thornton talking about how 85% of businesses are going to change hands over the next 5 to 10 years. And what that really means is that a lot of companies also will be coming to market in time as those baby boomers start to transition out of their businesses, or continue rather to transition out of their businesses. And the more supply you have of businesses, the more options than the buyers have, and therefore that tends to drive down pricing a bit for companies. So as there is a larger swell of companies that are good companies that are coming to market, that's going to have some impact as well, and it'll be a negative impact on the business. That being said, the economic recovery post-COVID is all the consensus right now is saying it's looking pretty strong. And if that's the case, that's going to impute to higher valuations for companies as they start, getting back to doing well and increasing their earnings, increasing their revenue, more predictable in the future with projections. All those things bode very well for companies that are looking to sell as they look to have and look at a competitive process with a number of buyers looking into trying to acquire them and competing to acquire them. The value of construction is, some are saying it's going to grow lightly. It's going to lag a little bit on the overall economy because there's been quite a bit of construction of late. That depends on where you are. As certainly in Colorado, there's still a lot of housing construction that not only is going on, but also is needed as the population continues to swell. So, we're watching that. We're not necessarily seeing a negative impact on that yet, but we're keeping an eye on that to see what happens with construction going forward. Some question about some infrastructure construction that might wane a little bit in the coming couple of 3 years. But at the same time, there's with that much housing being built, there's a lot of infrastructure pressure as well. So we're keeping an eye on that. But all of these kinds of factors, and there are more factors than just these, have an impact. But really, I think that these are things that you don't have any control over. These are things you have to watch over time to make sure you understand where they are and whether now is the right window of opportunity to harvest it, to sell the company or bring in a financial partner to maximize the take home that you get from that, or is it in the future sometime because there are some things fundamentally that you need to do with your business in order to get it to the next level, such that you can get further value going forward. And it's always a balance because these are these macroeconomic things that you don't have control over, but could have a significant impact on the value of your business. And at the same time, you may have some things where you can really do some things to goose the value of your business just through performance and higher EBITDA and higher revenues. And it's a tough balance because if you have something that happens from the outside that changes the multiple for your business to where it's no longer a 5x multiple, it's a 4x multiple, but you're also trying to do some things to increase EBITDA, you've got to increase EBITDA substantially in order to overcome that macroeconomic decrease in the multiples. And you should always have to figure that out and balance that out to figure out what the best time is for you to be able to best get the highest and best terms out of the business. Colorado construction market, just a little bit about where the volume is in Colorado and different areas of construction. You can see residential, of course, is the biggest part of it. Commercial is pretty strong. There's a lot of infrastructure that may be coming down a little bit projected, but as you can see, there's a lot of construction that's planned out and that is projected for Colorado. So this is a good state to be in the businesses that you guys are in. Okay, so I talked quite a bit about those things that you can't have an impact on. These are the things that you do have an impact on. These are the things that you can do with your business in order to get the highest and best value of your business when you do decide to to sell or to bring on a financial partner. And really, you got to think about valuation always as a spectrum. And there are certain characteristics of businesses that will keep the value range at the bottom end of the spectrum, and then there are other aspects that will pull the value up for a business. And it's just a question of managing the associated risk with trying to pull it up and change the aspects of the business to get to a higher valuation versus what that reward will be. And so we look at it from four different real fundamental vectors. There's predictability of the business, its differentiation in the marketplace, and our opportunity, the total market opportunity for the business, and what kind of margins they're driving from the business. And so I want to talk a little bit about each of these because these are very specific levers that you can pull and buttons that you can push within your business to help get to higher valuations. As far as predictability is concerned, of course, high revenue concentration, customer concentration, or end market concentration, that will drag down your the perceived value of the business, and that's manifested in like if you had a high concentration of projects that you were doing in the retail space or the hospitality space last year, then it's very possible that your business may have dropped off pretty significantly because those specific industry sectors got hit really hard with COVID. Therefore, your revenues probably dropped and EBITDA probably dropped as a result of that. And so the company is just not very predictable. If some outside shock comes along and changes the dynamics of the business and changes it pretty substantially, then that has a big impact on the perceived value of your business. By contrast, if you have a lot of different end markets that you're going after, if some of your stuff is in civil and some of your stuff is in maybe restoration or reclamation or disaster recovery, that kind of thing, if some of it is in maintenance with among a number of different verticals of business, then you could end up with enough end market diversification such that things like COVID don't have an impact on you, maybe even have a positive impact for you from a revenue and earnings standpoint. And those kinds of things are very exciting to buyers because it lowers the risk for them. And so any way that you can inject predictability into your business by having a number of different types of customers, a number of different end markets, and maybe even a number of different service offerings that you're providing, then that's going to be very beneficial for you from a perceived value standpoint. Similarly, if you've got things where you have circumstances where you have very high backlog, or if you have and also if you have more recurring revenues that you're providing. I mentioned HVAC companies and their maintenance programs that they have for commercial buildings as an example, where they're getting contractual revenue on a periodic basis ongoing. That's very, very attractive. And those kinds of circumstances really help enhance the value of the business. With differentiation, pretty much any buyer looks for, as much as possible, a moat around the business that allows the business to continue to grow and to acquire customers because they look different or they have a different feel to them than others do. So if you have any kind of technology, any kind of intellectual property or trade secrets, that helps a lot. A view on, if there's a perception of you in the marketplace where it's very high quality, high safety, great service, strong culture, those are all things that are really appealing to buyers. Group I'm working with right now has a really strong culture, but also they are very well known for the service that they provide in the market, which allows them to do some negotiated contracts as opposed to just doing RFP bids. They have long-term recurring customer relationships that they're constantly doing things. These are things that are really imputing a lot of value to this business. And those kinds of things are very, very beneficial to cultivate and very important to cultivate. But at the same time, opportunity is really important from the standpoint that if you have a very small market and very niche and not much opportunity for growth in that market, then you are going to be, you're going to have a ceiling to the top end of how much growth you can achieve, and that's going to be seen very quickly by the buyers. But if you're going after markets and customers where there is a longer term demonstrable view into how much they're going to consume of your services and your capabilities going forward, then that's just going to you're going to be able to project out a growth over a longer period of time in both top line and bottom line in such a way that again going to be much better perceived in the by the buyer community. I end up working with quite a few groups that are just private companies, where the common answer is, as it relates to opportunity and projections. Often the response when I ask about projections is, you tell me what's going on in the market, and I'll tell you what the projection is. And some of them, frankly, wear that as a badge of honor, and you know, that does you a huge disservice, not only in how you can present your business to the buyers, but just in being able to track your business and know how your business is performing now and how it's going to perform in the future, and make capital expenditure decisions and those kinds of things based on the future. You really need to understand what it looks like, where your backlog is, and how much backlog you're going to burn through in a given period of time, how much more pipeline you're going to be able to bring in, and how many deals or projects you're going to be able to win, and what that's going to look like 5 years out. You really got to be able to project that out. It's extremely important to be able to project that out, and then also measure against those projections over time, and learn where you measured incorrectly or where you projected incorrectly, why you projected incorrectly, and make adjustments to your methodology for that. If you can build that into your business and do that at all levels of your business, you are going to be extremely successful operationally, but you're also going to be extremely successful when it comes time to diversify your wealth and sell some part of the company or all of the company. It lowers risk, and it makes it much more predictable. That's a very good discipline to put into your business. And then, you know, I would say probably on top of that, you want to be, it would be very important for you also to put in, make sure that you not only have that ability to be predictable and differentiable and have, you know, understand the opportunities going forward and drive strong margins. Yeah, you need to do that not just by yourself. You need to do that with a good management team. And it's really important to make sure that you have a management team in place who is able to manage the operations, and is able to bring in new customers, and is able to deliver for those customers in a high quality, high safety manner. And the more that you can do that with a management team, as opposed to just you as the business owner, the better off you're going to be. You want to get to the point literally where you can take a 2-week vacation. And if the place just runs like a top while you're gone, then that's perfect. That removes a lot of risk on the part of the buyer when they're looking at buying and giving you a chunk of money, and you're probably going to go buy an island somewhere. They need to make sure that they feel comfortable they're still going to be able to run the business with the people who are left. And that's the better management team you have that has a good methodology of managing the business over time, the better off you're going to be. So those are the kinds of things that you really want to think about with as it relates to really building value into the business itself and creating organizational value for your business, as opposed to necessarily just having something cash flow as well, but it's all dependent solely on you. Okay, so trying to go to the next. There we go. Just real quick, I want to talk a little bit about what kind of buyers there are out in the marketplace and how they play. I think this would probably be pretty important for you to know, particularly when you're getting those inbound calls coming in. You got strategic buyers, and the strategic buyers are those that are in the same kind of business as you are in, or very complementary to what you're doing. Maybe they're in a different region, but they're doing it in your area. They want to move into your region. And so there are certain advantages and disadvantages to a strategic buyer. Advantages, they may pay a premium because they can get some credit, some synergies in the business. Synergies means that they can buy you and that they can take out some of the functions from your business because they already have that function. So HR maybe, accounting maybe, management, CFO or COO, they may already have that. And so they probably may not need that. They can take that out, and therefore they can get immediate synergies. Very simply, the read of that is that there's some disruption that comes from being acquired by another strategic. And so you have to be aware of that, and you have to either accept that or you have to put some parameters around that. There are disadvantages to a strategic. Certainly, it's a slower process. Usually for them to be able to get a transaction done, usually it's a little bit more cumbersome, and it can be, while they may be able to pay more, they may not be as creative as far as engineering the transaction to the benefit of the seller. What you want to look for when talking to a strategic, if you're out there, if you've answered the phone and you're talking to someone, you want to find out how many times they've done this before. You're probably you're gonna want to find out if they actually have the capital in order to be able to execute. You're gonna want to talk to past groups that they bought and see how that worked out, and what the results were. You want to know if they have like a kind of a defined model of integration and bringing people in, and for those that they have to cut loose, what's that look like? Just so you make sure that it's going to be, you know exactly what you're getting into at the end of the day. The other ones here are more focused on private equity, and I spend quite a bit of time on private equity throughout this conversation because, frankly, they're the 800-pound gorilla. They're the ones in the marketplace that are really driving values, and they're the ones in the marketplace who are setting a lot of trends as far as how companies are acquired and how they're integrated, and how they're viewed in the marketplace. They're unfunded sponsors. You'll probably get a lot of calls from these guys, and basically what they're saying is, hey, I've got money and I want to buy you. But you really have to ask the question, do you really have money, or are you going to come up with a deal with me? And then you have to go out and find the money, because there are a whole bunch of these guys out there where basically they don't have any money behind them. But if they have done deals in the past, or they've done deals with PE in the past, they may be able to get something done even though they don't have capital. If they're new in the marketplace and they haven't done deals in the past and they're unfunded, chances of them getting a deal done go down substantially. And so in those kinds of cases, you might not want to spend too much time with them. So you really have to qualify these guys who don't have readily available funds to see if they really have the wherewithal to be able to get something done with you, so you don't waste any time. By contrast, funded sponsors are the ones that do have committed capital. They have, maybe they have the Canadian Pension Fund or CalPERS, the California Employee Organization, who've put anywhere from a couple $100 million to a couple of billion with them so that they can deploy that capital. If they're funded, then there's a lot more capability of getting a deal done, and the probability of getting a deal done goes up quite a bit because they have to deploy that capital. And then I'll just cut down to the bottom one there, search funds. You kind of have to look out for search funds. They kind of have a bad name in the marketplace, and it goes like this. Hi, I just graduated from XYZ MBA program, and some of the alumni have put some money behind me to go find a business to buy in the next couple of years, and I'd be interested in buying your business. And while they don't say it that way, because that sounds really bad, it does play out that way. And so when these guys are, when they're guys and gals calling just out of graduate school, looking to buy a single business to run that single business, they probably are a search fund. And here's the challenge with the search fund. In most cases with search funds, they have you as the owner of the business, the seller of the business, to finance part of the deal. So they'll put down maybe 20% 20 or 30% of the capital necessary for buying the company. They'll borrow from a bank about, another, call it another maybe 50% of the business, and they'll ask you to finance about 30% of the business. In other words, take a seller note for a period of time, and it's subordinated to the bank, and that seller note probably doesn't start paying until after the bank's paid off, so call it 3 to 5 years, and then it starts paying you a coupon basically for an amortized amount of the loan over another 5-year period. Problem with that is they're just coming out of school and they're still pretty wet behind the ears, and they're going to run your business, and you're going to give them a seller note for a large chunk of it, and you're only going to collect that if that business still exists coming in 5 years plus. So you got to ask the question, how well are they going to be able to run that business? And if you think they're not going to be able to run that business, then you probably don't want to finance with a seller note. So with search funds, you probably get a lot of calls from these guys where they want to buy one company and operate it. Look askance at that. Make sure that you're not getting into a situation where you're not going to be able to collect on that seller note, and you just end up significantly harming your business. Okay, I just covered a lot of stuff. I think I've covered pretty much everything I wanted to cover that was any kind of formal discussion. I guess I'm going to stop sharing because I'm not seeing any kind of questions or anything like that coming up in the chat, because I'm not seeing the chat. So I guess I'm ending the slideshow and now looking to, are there any comments, any questions? Let's see. What can business owners do now to position their company to be attractive for buyers? And how many years prior to exit should an owner be planning their exit? Yeah, that's a fantastic question there. Okay, Chris, thanks for asking that question. First off, you should probably be planning about, you should be planning about 1.5 to 2 years out if you have the ability to do that. And you should engage with someone who's going to help you understand how outside buyers look at your business and what characteristics are important about the business. I think really what you can do, let's talk about personal and professional. On a personal level, if you're a couple of years out, you want to really look at estate and look at how once a transaction takes place, what's going to happen with that, and what's the tax bite potentially going to be, and what can you do to mitigate that tax bite. That's a conversation you want to have with your estate planning group or individual, your tax counsel. It's a very worthwhile investment. I see a lot of people avoid that because they think, I don't want to spend that $5,000 to have that conversation with someone, and boy, do they regret it when they pay another $250,000 in taxes when the deal closes. It's worth the investment. And the second thing is, on a professional level, I would encourage you to have someone help you understand how a buyer looks at your business and what things they're looking for in value for a business, specific characteristics about the market or about pricing or about about inventory and your capital equipment, and just give you a sense of how the buyers are going to look at that and what kind of adjustments you can make in order to make that happen. And then I would also say the last thing, going back to management team, make sure it's someone who's running the business as well as you. Make sure it's not just you as the owner of the business and the one who has all the relationships with customers and vendors and those kinds of things. Diversify that out into a management team that's going to mitigate risk. Okay, and I think there was one other here from Joseph. Oh, no, that's totally something different. All right, well, there you go. Any other questions? No.
It was a super informational segment, Adams, and very informative for people that are needing to understand how to value your business.
Well, I'm glad. Glad to hear that. If anybody wants the slides, feel free to, you can ping me on LinkedIn, or you can ping me directly at PMCF. Happy to do so.
Well, if we are not seeing any other questions, I believe we'll kind of sum this up. We would like to thank Adams and P&M Corporate Finance for being today's keynote presentation, and we'd like to thank you all for attending and discussing how to value your business and getting you all of the information so that you're in the best position possible. I would like to wrap things up by saying that I have the pleasure of being today's lunch and learn topic. We're going to be jumping over to the session right at 12 o'clock, talking about how the Blue Book can help you build your business. So if you have time to stick around for a quick 30-minute presentation, I'll be jumping over from this session into our lunch and learn today and helping you understand how to build your business. So I think with that, Adams, we'll let Deb take us out of this, and we want to thank everybody, and hopefully I will see you guys over at the Lunch and Learn with the Blue Book.
Sounds good. Have a great weekend, everybody. Thank you.